Morning, everyone. Welcome to our session. I'm just going to give another 2 to 3 minutes just to make sure that everyone that wants to join the session gets time to do so. And then we'll start. Let's make it my 9:05. Okay, so if there's someone that quickly wants to grab a cup of coffee or something, you've got your 5 minutes and then we'll start. Hi, morning again, everyone. I see there were some 13 more students that joined, so I'm very glad we gave you a few minutes. Okay, so for today, we're going to have a look at the 2024 test paper, and then we'll see if we have some time, we can also look at the 2023 paper. I have the memos for both of them, so we'll just see how time allows us to do this. Okay, so I'm going to share my screen. Okay, so now you can see my screen. Just again, if you have any questions, you're more than welcome to type it in the chat, but I'm not necessarily going to get a notification. Okay, so I will get back to all the chats, but if it's something urgent, you're more than welcome to just interrupt me, unmute your mic, and then you're welcome to talk to me. Okay, so 2024 paper. So you'll see question 1 was a very theoretical question. And this is a good question that they actually like to ask. So sometimes they can combine this in the paper and then they just give you one question and then you have to do the theory behind that. You have to do the journals and maybe 1 or 2 financial statements. Okay. In this question, however, on this paper, question 1 was a separate question. And the reason for this is they tell you there at the start that Green Limited acquired 45% of the ordinary shares in Gala Limited on the 1st of January 2024. So if we just look at that sentence, you won't be able to do all your journals because they do not have control. And remember, your test is on Learning Unit 1 and Learning Unit 2, and there the company need to have control for this to actually then work. Okay, so that's the reason why they split the questions. Whereas the paper for 2023, they gave you one question and everything was based on that question. Okay, so on that same day, Green Limited acquired call options for 10% of the ordinary shares of Gala Limited. And these call options are exercisable at any time, and the exercise thereof is based solely at the discretion of Green Limited. And Green Limited has no other rights over Gala Limited. And then they ask you to discuss with reasons whether Gala Limited is controlled by Green Limited on the 1st of January 2024. And then your answers must comply with the requirements of IFRS, particularly IFRS 10. Okay, so this control question is a question that they like to ask. If you look through all the previous tests, there's always some or other scenario, and then they ask you if one company controls the other one. Okay, so in this one, if we just look at the percentage, if you say they acquire 45% of the ordinary shares, they do not have control. But they tell you they also have a call option of 10%. And then very important, that call option can be exercisable at any time at the discretion of Green Limited. Okay, and that's important. Okay, so if we have to discuss control, then remember there's 3 criteria that they have to meet. If one of them is not met, it's not control. And that is power. Then number 2, exposure or right to variable returns. And then number 3, the ability to use the power to affect those returns. Okay. And you have to mention that. And then you see, okay, do they have power? Do they have exposure or rights to variable returns? And do they have the ability to use that power to affect the returns? Okay, so you start with Gala is a subsidiary of Green if it can be established that Green has control over Gala. And then we said, okay, this criteria needs to be met. Now we go to power. Power is held when the investor has existing right to direct the activities of the investee. And this can be achieved by I'll continue now. I just want to give you a bit of time. If there is someone that wants to take a picture or anything like that. Just on that note, the slides will be shared with you after the session. You are also, again, more than welcome to send me an email, and then I will also share the slides with you. Just again, maybe try 1 or 2 per campus if that's possible, because otherwise I can't get to everyone, and I know you are writing tomorrow morning, so I know you are anxious to get these slides. Okay, so power can be achieved by voting rights. So green owns 45% of the ordinary shares. This does not constitute a majority. So on its own, this does not give green power over Gala. But they also have this call option of 10%. And as these options are exercisable at any time, at the discretion of green, they will be considered in the assessment of power. Okay, so if there's a decision that needs to be made and they need to vote, then they can say, okay, I want to use this 10% call option now. And then technically they have a 55% share, meaning giving them the majority rights. Okay, so if the current voting rights and the options are considered together, then power exists as green can then direct the activities of Gala. So that's the one thing, the voting rights. The other thing is the existence of other rights. And in this scenario, green doesn't have any other rights over Gala. Green has the right to variable returns in the form of dividends paid by Gala. And then Green Limited can use its power through voting and contractual rights to direct the payment of returns. And then as all the criteria for control have been met, Green Limited does have control over Gala on the 1st of January 2024. Okay, so very important, if they ask you a theoretical question like this, always go back to your definition. What is the definition of control? And then you describe whether this company then actually meets this definition that they should meet. Hi, any questions on question 1? Let's quickly see if there's something happening. Okay, then we can move to question 2. And then you'll see question 2 is now the one where all the journals and everything is going to take place. Okay, so they tell us there, and you'll see this is 45 marks. So the following are trial balances of Buffy Limited and Tribbiani Limited for the financial year end 29 Feb 2024. Okay, they give you debits, they give you the credits, there's some additional information. So they tell us Buffy acquired 70% of the ordinary shares on the 1st of March 2022. I'm going to show you some important things as we go. Okay, so you might want to make some notes if you want to. Before we even look at the required part, there's things that when you read through your question, you need to be able to do certain things. Okay, so the first thing is, in this scenario, they give you the percentage. Okay, they tell you they acquired 70% of the ordinary shares. But it can happen that that's not given. They can tell you something like they acquire 500,000 ordinary shares. Then you do not have the percentage. And then it's very important to calculate the percentage. Because remember, as we go on, we need to also say what is the non-controlling interest portion. So we need to know the percentage so that we know what the non-controlling interest portion is. Okay, so if they give you that scenario, if they tell you they acquire 500,000 of the ordinary shares, and now you have to do the calculation, then you'll go to your trial balance. And then under the credits, you'll see they give you ordinary share capital. And next to that, in brackets, they'll probably then give you the total shares that this company have. Okay, in this case, they didn't because you don't need that because they gave you the percentage. But if they didn't give you the percentage, then they will tell you there in brackets either how many shares the company have, the total, or if they put there in brackets that one share is R1, then you'll know that the first company will have 1,315,000 shares, and the second company will have 750,000 shares. Okay, so then you will take the amount of shares that they give you, what you required, and divide that by the total times 100 will then give you the percentage. Okay, so that's the first thing. They need to either give you the percentage or you need to calculate the percentage. Okay, the next thing is we need to know what they spend on getting that percentage interest. Okay, sometimes they can tell it to you like they do here under the additional information. So there they tell you they acquired ordinary shares for 675,000 Rand. If it's not there, if they didn't tell you under additional information what they paid, then you have to go to your trial balance. And then you'll see there'll be an investment in that company's name. Okay, so in this case, it's Tribbiani. So that investment in Tribbiani is then 675,000 Rand. So that's then where you'll get your consideration paid. Okay, so it can be given to you like they do in this question. But if not, then you have to go and check your investment in Tribbiani. Okay, then the other thing we need is we need the retained earnings or any other equity, all the amounts on the date of acquisition. Okay, because you'll see if you go to the trial balance, this is the figures for 29 Feb 2024, but we acquired this 70% in 2022. Okay, so we need figures for 2022. And then they tell us at this date, all the identifiable assets and liabilities of Tribbiani were fairly valued. Okay, if they give you that sentence, then you know that at acquisition, we're not going to have any revaluation, any remeasurement, anything like that. Okay, then number 2, they tell us there was no change in the issued shares of Tribbiani since the 1st of March 2022. Then number 3, at the beginning of the current financial year, Buffy became the sole supplier of inventory to Tribbiani, and they sell inventory to Tribbiani at a markup of 10% on cost. Then they tell us there's a loan to Tribbiani. A loan of 250,000 was granted on the 1st of March 2023. The loan is repayable in 5 equal annual installments on the 28th of Feb every year. The current year's payment has been made. The loan accrues interest at 10% per annum. The interest for the current year has been accrued. Then included in other expenses of Tribbiani's is an amount of 15,000 for management fees paid to Buffy. Okay, let's just stop there. Okay, so number 3, number 4, and number 5 is intercompany transactions. And remember, all these intercompany transactions needs to be eliminated. Okay, if there's a sale of inventory, we need to eliminate. If there's a loan, we need to eliminate. If there's interest on the loan, we need to eliminate. If there's management fees, like we can see there, we need to eliminate. Okay, then they tell us goodwill is not considered to be impaired at year end. The non-controlling interest is measured at their share of net identifiable assets. The normal tax rate is 27%. And then at the required part, they ask you to do the pro forma at acquisition consolidation journal entry and the pro forma journal entry to account for retained earnings of the Buffy Limited Group at the beginning of the current year. Then they tell you journal narrations are required. Okay, so very important. They do not ask us to do all the journals. We only do the at acquisition journal, and then we do the retained earnings, that movement from at acquisition to the beginning of the current year. Then they ask us to do the statement of profit and loss and other comprehensive income. And then lastly, they ask us to calculate the non-controlling interest balance that would be recognized in the consolidated statement of financial position of the Buffy Limited Group on the 29th of Feb 2024. And then again, your answer must comply with IFRS and specifically IFRS 10. Okay, so let's quickly look at this. So you'll see I made some steps. And just remember, this is not compulsory at all. This is just sort of trying to guide you to try and remember all your journals. Okay, because especially if you are going into a test and there's a lot of stress and everything, you tend to forget some of the journals. Okay, so if we try and follow the steps, then hopefully you will then remember all your journals. Okay, so I said step 1, and this is the at acquisition fair value. And this is if all the fair values are not fairly measured, then we have to do a revaluation. That revaluation will be on buildings or any other non-current asset, or then remeasurement journal, and that is specifically on inventory. Okay, and that will happen if they told you at additional information number 1, if they tell you something like, at this date, all the identifiable assets and liabilities were fairly valued, except for buildings, and then they give you an amount for buildings. Then you know, okay, but buildings was wrong, so I need to revalue my buildings. Okay, so let's say, I just quickly want to see. Okay, they don't actually have buildings separately. So let's say they said, except for property, plant, and equipment, and that was 2 million rand. Okay, you can see currently that property, plant, and equipment is at 1.75 million. So if they told you that all the fair values are equal, except for PPE, that was 2 million, then you know the difference between the 2 million and the 1,750,000, we need to then use that as a revaluation. Okay, so that's then going to be step 1. Okay, but in this case, since they told us that everything is fairly valued, we're not going to do step 1. Okay, then step 2, this is the elimination journal. Okay, so at acquisition, we need to eliminate all equity. Very important that all equity, it will always be retained earnings. There will always be retained earnings. But they can also give you something like a general reserve. They can give you mark-to-market reserve. And then also, if you had a revaluation or a remeasurement at step 1, you are also going to eliminate that in step 2. Okay, so in step 1, we then basically recognize that revaluation or remeasurement. And then in step 2, that becomes part of the elimination journal. Okay, so very important, we eliminate all equity. Okay, and then obviously share capital will also always be in there. Okay, so let's go to the trial balance to see what equity we have there. So you'll see they give us ordinary share capital. They give us retained earnings. There's no other equity. Also, at additional information, they only gave us the amount for retained earnings. They didn't tell us that they also have a general reserve or a mark-to-market reserve or whatever. So we will then only eliminate share capital and retained earnings for the equity. And remember, equity by default is credited. So now if we eliminate, we have to debit the equity. Okay, so we debit share capital, we debit retained earnings. Then the other important thing is which figures to use. Okay, you've got two columns there. So it's important that if Buffy acquire the shares in Tribbiani, we focus on Tribbiani's figures or their amounts. Okay, because we need to eliminate them because Buffy is purchasing the majority of shares, so they have control over Tribbiani Limited. Okay, so for share capital, we'll use the 750,000 because they tell us there at number 2, there was no change to the issued shares of Tribbiani. So we use the 750,000. And then very important for retained earnings, we use the amount at acquisition. Okay. Also, if they gave you a general reserve or any other equity, you will use the amounts at acquisition. Okay, I'll show you the journal just now. Then what we also need is the investment amount, okay, or then consideration paid, because that we also need to eliminate. So this 675,000 we need to eliminate. So we will then credit investment in Tribbiani. Then we also need non-controlling interest. And how we calculate that non-controlling interest is the total of your equity. So in this case, it will be the share capital and the retained earnings. And then we times that with the non-controlling interest percentage. Okay, so we said at the beginning they acquired 70% of the ordinary shares, meaning there's a 30% that they do not control. And then your balancing figure in this journal will then be either goodwill. So if it's on the debit side, we have goodwill. If it's on the credit side, we have gain on bargain purchase. Okay, so that journal will then look like this. So you'll see we debit share capital, 750,000. We debit retained earnings, 150,000. That's the amount at acquisition. Then we credit the investment. We credit non-controlling interest. And we said for non-controlling interest, it's your total equity times 30%, because that's the percentage we do not control. And then goodwill will be our balancing figure, which is then the 45,000. Hi, any questions there? Yes, so there's a question. Is the investment in Tribbiani the consideration paid by the parent? Yes, that's correct. Okay, so if they didn't give you the consideration paid amount at the additional information, then that's where you're going to get that. Okay, there's another question. How do we know if it's included in the intergroup transaction journals that need to be eliminated when it's not in the additional information? So they purchased this in a previous year, so it will always be included. Okay, even if it was purchased at the beginning of the current year, then it will still be included in that journal. Okay, so because they acquired the interest previously, it is included there. Yes, so the total of the NCI is the sum of all the equity being eliminated and then times the non-controlling interest percentage. So yes. Hi, any other questions? Okay, let's continue. Okay, so if you then try and use my steps, so we said step 1 is revaluation, remeasurement. Okay, that's not going to happen in this question. Then step 2 is the elimination journal. Okay, so that's the one we just did. Then step 3 is now the movement in equity from since acquisition to the beginning of the current year. Okay, again, it will always be retained earnings, but there can also be other equity, like general reserve, mark-to-market reserve, something like that. Okay, so it will always be retained earnings, but there might be other equity as well. Okay, so now we go back to our trial balance to see what the retained earnings amount was at the beginning of this year. And you'll see there at the top under your credits, you have retained earnings, and this is on the 1st of March. Okay, your trial balance, is on the 29th of Feb, but your retained earnings is the beginning of the current year. Okay, so now we use this 360,000. Remember, we're using Tribbiani's figures. So it's the 360,000 minus the 150,000 that it was at acquisition. And again, times 30%. Okay, so we only focus on the non-controlling interest part. Okay, so then your journal will look like this. So we debit retained earnings, we credit non-controlling interest. Okay, so it's the 360, that's the amount at the beginning of the current year, minus the 150,000, which is the at acquisition amount. And then we times that by 30%, because that's the non-controlling interest percentage. Okay, and then up to there, that's all that they asked you to do in this question. Okay, because they asked us at the required part to only do the journals at acquisition, that's the one we did, and then the journal to account for the retained earnings of the Buffy Limited Group at the beginning of the current year. Okay, so we did that. Okay, but I think maybe we're all going to have time. So maybe we can do the other journals as well. Okay, I'm going to do that in Excel, unfortunately, because I didn't put it on the slides, since it wasn't part of the question. So I'm going to do it in Excel for now, but then I will add it to the slides when I share the slides with you. But I think that's definitely going to help, especially then if you have to do the statements thereafter. Okay, so let's go back to my steps. Sorry. So just again, remember the steps is not compulsory. It's just trying to help you with doing all your journals and not forgetting some of that. Okay, so now step 4 is to eliminate all intercompany transactions. And some examples is a sale of PPE. So the one company selling some or other PPE to the other company, a sale of inventory, then management fees, and that fees is income and expense. Okay, because remember the one is going to pay, so for them it will be an expense. The other company is receiving, so for them it will be income. Okay, so it will be management fees, loan, interest on the loan, and then rent paid and received. Okay, so that's step 4. We now need to eliminate all intercompany transactions. Okay, so if we go back to the additional information, we said at number 3, that's an intercompany transaction because they are selling inventory. Then number 4, that's an intercompany transaction because there was a loan. Sorry, I just quickly want to make sure. Yeah. Okay, so they tell us the details of the loan to Tribbiani are as follows. Then they tell you there's a loan, there's also interest. So that's intercompany transaction. And then at number 5, there's also management fees that they paid. Okay, so let's look at those journals. Okay, so we said step 4 is then to eliminate all intercompany transactions. Okay, so the first one we have there is the selling of inventory. And there the important thing to remember is you will have 3 journals. If there's a sale of inventory, there's 3 journals. The first one is the total revenue needs to be eliminated. Then after that, we eliminate the profit. And then on that profit, there will be a tax effect. Okay, so let's quickly look at that. Okay, so I'm going to open Excel. Okay, sorry, like I said, this wasn't part of the plan, and then I decided to quickly do that now. Okay, so let's just do that. So there's your debits, there's your credit. Okay, so when we then do this journals, the first journal is we debit revenue, we credit cost of sales. Okay, that's the first journal. And now they tell us at the additional information that they are the sole supplier of inventory. Okay, so let's just quickly see what their amount is. So their cost of sales amount is 1,355,440. So because they are the sole supplier, they don't have to tell you exactly what the amount is that the one company purchased from the other company. Okay, so you can use the full cost of sales amount as your amount that you need to eliminate. Okay, so that's the first thing. We eliminate everything that they sold to them. Okay, so we debit revenue. We said that's 1,355,440, and then cost of sales 55440. Okay, that's the first one we do. Then we also need to eliminate the profit. And they tell us there they sold inventory to Tribbiani at a markup of 10% on cost. Okay, oh, sorry. There we go. Okay, so now we debit cost of sales. We credit inventory. Okay, so normally they will tell us what the inventory on hand was. Okay, and that is specifically if they are not the sole supplier. Then they need to tell you the inventory on hand was whatever. In this case, they didn't. So we can go to the inventory figure on the trial balance, and then you'll see there your inventory is 55,000. Okay, so now we take that 55,000. We times that with 10 because they make 10% markup on cost. So it's times 10 divided by 110. Okay, so that's your calculation. Then if you do that calculation, you get 5,000 Rand. Okay, so this is now eliminating the unrealized profit. Okay, and then remember, on this unrealized profit, there will be tax. But now you need to figure out, do we debit deferred tax or do we credit deferred tax? Or do we debit income tax or do we credit income tax? Okay, so what works for me, so if you debit your expense, okay, that's exactly what we did now. We debit the expense. That will then increase your expense. Okay. If we increase the expense, that will decrease your profit. If we decrease the profit, that will decrease tax. And if you decrease your tax, your credit will be income tax expense. And then your debit is deferred tax. Okay, so on that 5,000 Rand, that's 27%. Okay, I will quickly just re-explain this. So in this current year, if you affect income or expenses, there will be a tax effect. Okay, if we look at this first one, the tax effect there will be 0 because we debit revenue, so we decrease income and we decrease the expense with exactly the same amount. Okay, so your profit is not going to change, so your income tax is not going to change. But now in the second one, we change cost of sales. Remember, inventory is an asset, so that's not affecting income or expenses. So if we change the expense, so if we debit the expense, we are increasing our expense. If you think about your profit and loss statement, if you increase your expense, you are decreasing your profit. Okay, your profit becomes lower. If your profit is lower, then you're going to pay less tax. So if we decrease profit, we decrease tax. So then we credit income tax expense. So then you know the debit will be deferred tax. Okay, that was a mouthful. Any questions on that? Okay, Blessings, you ask, if there is inventory on hand, do we subtract it before calculating profit? No, you're going to use that inventory on hand to then actually calculate the profit. Okay, let's just quickly see. Okay, that one I answered. Is this journal we're doing in the books of Buffy? Yeah, so all the journals we do is for Buffy, since Buffy is the parent company. But we focus on the amounts for Tribbiani. Okay, then what are the narrations? Oh, yes, thank you. Okay, let's quickly look at the narrations. Okay, let's put that in for you as well. Okay, so the first one will be to eliminate sales of inventory. Then the second one is we eliminate the unrealized profit on inventory. And then the last one is the tax effect on the unrealized profit of inventory. Okay, so if there's a sale of inventory, this will always be your 3 journals. Okay, but remember, we cannot stop there. So we're still busy with step 4. And for step 4, we said that we need to eliminate. Yes, sorry.
I didn't quite catch where you got that 55K from.
Okay, let's just quickly jump back. The 55, this one.
Yes.
Okay, so they didn't give it to you. Let's just go to the question. Sorry. So normally when they tell you about the sale of inventory, they will tell you what's the inventory on hand. Okay, but in this case, because they specifically tell you they are the sole supplier, meaning all their inventory is coming from this company. So then you can go to your trial balance. Under your inventory, you'll then see the 55,000. And remember, we're using Tribbiani's figures. So that's where you'll then find the 55,000.
Okay, thanks.
Okay. Okay, so back to the steps if you want to use that. So we're still busy with eliminating intercompany transactions. Okay, so we didn't have a sale of PPE. Then we had a sale of inventory. So that one we did. But now we also have to look at management fees, any loans, any interest on the loan, and then the rent paid. Then in the question, at number 4, we had a loan. And they tell us there was a loan granted on the 1st of March. They tell us what the loan repayable amount or what the installment is, and then there's interest on that loan. Okay, so you will find the amounts in your trial balances. Okay, so there will be a loan to Tribbiani or a loan from this company. And then there at the debits, you can see loan to Tribbiani, 200,000. And then you can know that for the other company, the amount will be exactly the same. Okay, and then we have, okay, so on this one, they only tell you long-term loans, and then it's 200,000. Okay, so your loan to Tribbiani is currently a debit. So to eliminate this loan, we need to credit the loan to Tribbiani. So then we credit loan to oh no, it was double B, Tribbiani. And then we'll debit loan from Buffy. And the amount we said is 200,000. So you just get that on the trial balance. And you can then assume that any of the repayments and everything, or well, not assume, they actually tell you in the question. Let's just quickly go there. They tell you the loan is repayable in 5 equal annual installments. The current year's payment has been made. Okay, so you know that that payment is included in the balance for the loan. So that's fine. And then the interest is 10%. The interest for the current year has been accrued. Okay, so it is included. So we need to eliminate that. Okay, let's just look at the narration there. So this will be elimination of intergroup loan. And then on that loan, there will be interest. Okay. I just quickly want to show you if they have interest. Okay. You'll see they have other income. So that interest is probably in other income. And they have finance cost. So it's probably included there. Okay. So it's very important that you recalculate your interest, because that interest can also be other interest. Like maybe they paid SARS interest, or they have another loan, or whatever the case might be. So if they specifically in the question tells you that loan has got a 10% interest rate, it's important that you calculate 10% on the loan. Now, just very important, this 10% needs to be calculated on the original 250,000. Okay, because it's for this year. At the beginning of the year, the balance was still 250,000. They only paid the installment at the end of the year. Okay, so the balance of 200,000 is only at the end of the year. The balance where the 10% needs to be calculated on is the opening balance of 250,000. Okay, and then you will always debit interest income. You can also say other income, since they have other income on their trial balance. And then finance cost, or if you say interest expense. Okay, and that is on the 250,000, they charge 10%. Okay, and then we get 25,000, 25,000. And this is then elimination of intergroup interest on the loan. Oh, it's me loan. Okay. Any questions up to that point? Yeah, let's quickly see the questions. Sorry, I just want to start at the beginning. Okay, so let's start there. Okay, so what's the difference if you are asked to prepare the journals in the separate financial statements versus preparing the pro forma journals? Okay, remember these are two companies and they have separate financial statements. Okay, so if they ask you to do the journals in the separate financial statements, then for instance, if you have, let's say, to do an inventory journal, you will do that journal with the profit. Okay, because in their separate financial statements, the one company are making a 10% profit from the other company. But if we have to do pro forma consolidating journals, meaning these two companies are now becoming one in their financial statements, and then we need to eliminate some of the journals. Okay, so in the separate financial statements, you basically recognize everything, whereas when we then consolidate, we are eliminating the transactions. Okay, then there's another question. Why don't we do the analysis of equity before we do the journals? You're more than welcome to do the analysis. It's not compulsory, so that's only used for calculations. Okay, so if the analysis works for you, you're more than welcome to do that. Then can we say loan payable and loan receivable? Yes, that's fine. Okay, you don't have to say loan from this and loan to that. You can say loan payable, loan receivable. Okay, yeah, so there you are asking, can this analysis be used as your workings and calculations? Yes. So then when you do the journals, it's not necessary to put the calculations in brackets. Okay, the lecturer will then use your analysis to get all the calculations and all the amounts in there. So yeah, if Tribbiani was the sole supplier, we are going to use the inventory amount from Tribbiani from the balance sheet. Oh, you mean the other way around? Yeah, sorry. Yeah, sorry. Okay, I see your question now. So if Tribbiani was the sole supply, we're going to use the inventory from Buffy from the balance sheet. Yes. Okay, so you ask, is the loan not 250 and not 200,000? So remember that 250 is at the beginning of the year. but then they had installments that they paid, and then it becomes 200,000 at the end of the year. So we do the end of the year journals when we consolidate. So then the balance is 200,000. Okay, so I see two of you had questions on that. So let's quickly just maybe discuss this. So your loan is in the separate company's financial statements. And then as it's being paid, that balance is changing. And then at year end, this is when we do the consolidation. Okay, and then that balance was 200,000 and not 250,000. Okay, then if the current year's loan repayment hadn't been made yet, how would we account for that? So then you will, depending on from whose perspective, then you will debit the loan in that company, credit bank, if that was then the payment part. But then for the other company, you will debit bank and then credit loan receivable. Okay, but they'll probably not ask you that because that's the separate financial statements. Okay, we're not focusing on separate statements. We're focusing on consolidating the statements. Okay, then I think I did re-explain that loan 200 and not 250. Okay, any other questions?
Yeah, ma'am. So
Yes.
if the question says like separate, then we're working with recognition, and then if it says pro forma, then we know we're working with elimination.
Yes, that's 100% correct. Okay, and then as I said earlier on, they'll probably not ask you really to do it separate because we are focusing on consolidation for learning unit 1 and 2. Okay, any other questions? Okay, then I see we're almost at 10 o'clock. Okay, so please take your break. And then at 10 past 10, then we'll continue with this question. Okay, let's continue. Okay, I see there's a question to just show the journal since beginning, revaluation movement. Just remember that is retained earnings. Okay, I'll show you the journal just now. Okay, so I am sharing my screen. Okay, there you go. Okay, so we're still busy with step 4. So we did the sale of inventory now before the break. Then after that, we had a look at the loans. So there was a loan between the two companies. So we eliminated that. Then we also had to eliminate the interest on that loan. Okay, so just quickly want to go back to step 4. So there you'll see there was no sale of PPE. We did the sale of inventory. We did loan. We did interest. Okay, so now we have to check for any management fees, any rent paid between the two companies. And then you'll see in the question, they tell us they at number 5, included in the other expenses of Tribbiani is an amount of 15,000 for management fees paid to Buffy. And this has been included in other income of Buffy. Okay, so now we also need to eliminate this. Okay, so for Tribbiani, other expenses is debited, so we need to credit other expenses. And then for Buffy, other income is credited because they've received money, so we then debit other income. Okay, so you can say other income and other expenses. Or if you want to say management fees paid and management fees received, that's also fine. Okay, so let's go back to Excel. Okay, so for your management fees, we'll then say other income, other expenses. The amount is 15,000. And then we will eliminate intergroup management fee. You can also say if you want to, management fee paid and received. Okay, then we've now done all the elimination journals. Okay, so back to the steps. Okay, so step 4 is then completed. Then step 5 is the non-controlling interest journal. And what we do in that journal is from the profit, there's a portion that we are not going to get because we do not control that percentage of the company. Okay, so to do that journal, we'll debit non-controlling interest, profit and loss portion, non-controlling interest, statement of financial position. Okay. Now you're going to have to go back to your trial balance because we need the profit. And then sometimes they are nice. They give you the profit or they give you the profit before tax. Or sometimes, like in this case, we have to calculate that. Okay, you can see they give you revenue, they give you other income, they give you cost of sales, expenses, finance cost, income tax expense. So in other words, they do not give you the profit. So now we need to calculate that profit. And again, remember, it's the profit for Tribbiani. So we're going to work with their figures. Okay, so we take the revenue plus the other income. And then from that, we deduct cost of sales, we deduct the operating expense, we deduct finance cost, and also very importantly, you also deduct the income tax expense. Okay, you need the amount after tax or the profit after tax. Okay, so then to do that, so we're going to say 298,190. So that's your revenue plus your other income minus your cost of sales minus your operating expenses minus the finance cost minus the income tax. Okay. If you do all of that, you get 627,020. And that times 30% is then your non-controlling interest. Okay, sorry, I just want to get the amount. I wrote it down now somewhere. Okay, so that is then 188,106. So if you take that 627,020 times 30%, you get 188,106. Okay, so that's then step 5. So on the profit, there's a percentage we do not control. Okay, and then my last step, let's say for learning unit 1. Sorry, let me just get to my steps again. The last step then is the dividends journal. And this is also eliminating, and this is specifically dividends paid. Okay, because we need to eliminate the dividends paid from Tribbiani to Buffy. But then you'll see if you look at the trial balance in this scenario, there is no dividends paid for Tribbiani. So there's not going to be any journal. Okay, so Tribbiani didn't pay any dividends. So therefore, we then ignore that step. And then I've added a step 7 specifically for learning unit 2. And this will then be a change of ownership. Okay, so in this paper, they didn't ask that at all. So we also don't have a step 7. Okay, any questions up to that point? Okay, there's a question. If they gave us profit before tax, we work out after tax, so times 0.72, then times 0.3 to get the NCI. You're not going to. That profit before tax, they will then also give you the income tax amount. Okay, they have to give it to you. And then you minus that amount that they give you, and then we times the 30%. Okay, so they will always give you the income tax figures as well. Okay, if it's really not given, then yes, you can say times 7.3, because remember the tax rate changed to 27%. Okay, so then it's going to be 0.73, but they will actually have to give you the income tax expense figures so that you can deduct that from the profit before tax. Okay, so step 6 is then the dividends journal. So the dividends is your company that you purchase interest in. So in this case, Tribbiani, the dividends that they pay out, we are also going to eliminate. So you'll see in this specific question, if you go to the trial balance, dividends paid, they're at the bottom. For Tribbiani, it's nothing. So there's no dividends that they paid. So we're not going to do that journal. If they did pay any dividends, then your journal will say dividends received, then non-controlling interest, and then dividends paid. This dividends paid will be the trial balance amount. So if the trial balance said 200,000, that will be 200,000. Dividends received will be your trial balance amount times, in this case, 70%, which is the percentage interest that they have. And then your NCI will be your trial balance amount times 30%. Okay, because there's a portion of that dividend that they're not getting because they are not controlling a 30% of that company. Okay, so if the dividends is asked, then it's going to look like that. And then you'll say eliminate intergroup dividend paid. Okay, so this will then be step 6 if it's asked, or if you have an amount to dividends paid. Okay, let's quickly see if we have any other questions. Okay. Okay, let's continue. So at number 2.2, they now ask us to do the statement of profit and loss and other comprehensive income. Okay, so very important, if you do your statements, you always start with the amounts they give you on the trial balance and you add the two companies' figures. And then you go and see, okay, but what in the journals are now also affecting these calculations? Okay, because you get half a mark for every amount. So if we need to do the profit and loss statement, remember that starts with revenue. So your revenue will first of all be the 5,350,000 plus the 2,981,960. Okay, so you add the two amounts for everything, for revenue, for cost of sales, for other income, other expenses, finance cost, everything. You first add the two companies' figures. Then after you did that, then you go to your journals. So in the question, even though they didn't ask you your journals, it might be a good idea to just somewhere make small notes for yourself that you don't forget that. Because if you now do the statements, you have to take that journals into consideration. Okay, so we add the two. Then you go to your journals and you see, okay, where was revenue affected in the journals? And where we affected that revenue was in the first journal that we did now for step 4, okay, which was not asked to do, but we then did that. And revenue was debited. So we need to minus the 1355440 from revenue. Okay, so then it's going to look like this. Let me just get there. Okay, so revenue. So the first two amounts is coming from your trial balance. And then the 1355440, this was a journal that we did. Okay, then next we have cost of sales. Again, the first two amounts is coming from the trial balance. The trial balance for Buffy plus the trial balance for Tribbiani. Then we go to the journals. We affected cost of sales in the first journal. So we credited cost of sales. So it's a minus 1355440. And then we also debited cost of sales. So we have to plus 5,000. Okay, so now we go to cost of sales. So we minus the 1355440. We add the 5,000. Okay, and there you'll see I just included the working for you to get the 5,000. But remember, when we now did the journals, we also discussed that. Okay, then we get our gross profit. So remember, that's revenue minus your cost of sales will then give you a gross profit. Okay, then they have other income on their trial balance, and that's why I must then try to stick to other income. Okay, and rather not put interest received or management fees received. You sort of throw everything as other income. So again, the first two is the amounts coming from the trial balance. The first one for Buffy, then for Tribbiani. Then again, we go to the journals and we see where was other income affected. And there we did other income. And there we did other income. Okay, so both other incomes are debited, meaning we have to minus other income. Okay, so we minus the 25,000, we minus the 15,000. Okay, then if you take your gross profit and you add this other income, we get gross operating income. Then we move to our expenses. Again, the first two expenses is coming from your trial balance. And then where we affected other expenses is there. Okay, you'll see the finance cost for them is separate. So that's why we'll do finance costs separately. So your other expenses was credited. So again, we have to minus the 15,000. Then you get an operating profit. Then from that, we deduct finance cost. So again, the first two is coming from your trial balance. And then the last one is the journal we did, okay, where we had the intercompany loan. And on that loan, there were interest of 10%. Then we get a profit before tax. And then you'll see on the trial balance, they have income tax. There's an income tax expense. So again, your first two figures will be coming from your trial balance. So the 256 and the 124 is from the trial balance. And then in the journals, we affected the income tax expense, where we had the sale of inventory, and we credited income tax expense, meaning that's a minus to your income tax expense. And then we get a net profit after tax. Okay, and then it's very important that you cannot stop there, because that's the total profit. But remember, of that profit, there's a 30% that we are not going to get. So we need to split this profit between attributable to the parent and then the portion that is not controlling. And we first fill in the non-controlling interest, because that's the amount coming from our journal. So we did the non-controlling interest journal. So this amount is what will then go to the non-controlling interest portion. And then the difference will then go to the parent. Okay, so we have the net profit, then it's attributable to the parent and the non-controlling interest. So we fill in the non-controlling interest portion. Then you take your profit after tax, deduct this non-controlling interest, and then we get the amount that the parent will get. Okay. Are there any questions on this statement? Okay, let's just start at the beginning. Okay, so there is a question. When will it be profit minus cost of sales plus tax times NCI to complete the NCI journal? That will be if it wasn't included in the statements yet. Okay, but they tell you everything is in there. So we can just use the balances that they gave us. Okay, if it wasn't included yet, then we will also add and deduct the journals that we did. Okay, then would you not add the deferred tax on the unrealized? Oh, what happened now? Okay, would you not add the deferred tax on the unrealized profit in the NCI journal entry and subtract the unrealized profit? Okay, so we're not going to do that for this one. The reason is everything was already included when they did the trial balance. Okay, they tell us that in the question. Then would dividends affect other income? Yes, it would. Okay, so if you had dividends and you do that dividends journal, you will affect other income with dividends, yes. But just remember, dividends paid, that will go to the statement of changes in equity. Okay, so that's not going to affect the dividends paid or the other expenses. That will go to statement of changes in equity. Okay, there's another question. Will I show the journal, what the journal would look like for an intercompany asset disposal? I'm going to do that in the 2023 paper. Okay, we will have time to quickly run through that paper as well. And in there, they have a machine that they're all selling. Okay, so we're going to do it there. Then where did the 2 million figure come from? Blessing, let's quickly see if I can get that for you quickly. Is it on revenue, that 2, or is it for the profit? Will you just quickly explain a bit more on your question, where that 2 million figure is coming from? Do you refer to when we calculated the profit or on the statement when we did revenue? Okay, then Matthew, the 13,000 is from other income. On the trial balance, there's a 13,000 other income. Okay, Blessing, so that profit, that's your revenue amount on your trial balance. Okay, so remember, if we calculate the profit, just quickly get there. We use the figures for Tribbiani because we are calculating their profit. So your revenue is the 2,981,000. Then we add other income. So there's the 13. Then from that, we deduct all our expenses. So we deduct cost of sales, we deduct the operating expense, we deduct finance cost, we deduct income tax expense. Okay. Okay. Then lastly, question 2.3 is then to calculate the non-controlling interest balance that would be recognized in the statement of financial position of the Buffy Limited Group. And this one is actually easy because we did all the journals on that. Okay, so it's the one from the elimination journal. So in this case, the first journal we did, the one where we had the movement in retained earnings, because we have the non-controlling interest balance there, and then the journal that we did for step 5. Okay, so all of that added together will then give you the non-controlling interest balance. Okay, so the first journal we did, that non-controlling interest, the 270,000 plus the 63,000 on the next journal. And then plus the non-controlling interest journal that we did for this current year. Okay, so if you add all of that, you get 521,106. Okay. Any questions on the 2024 paper?
Sorry, ma'am. Do you mind going to the slides? The slide after gross income.
This one.
Yes. Thank you.
Okay.
No, I just wanted to take a picture.
Oh, okay, perfect. Okay, let's see if there's any other questions. Otherwise, I'm quickly opening the 2024 paper as well. The 2023 paper, sorry. Then we can also just quickly run through that one. Okay, so there is a question to quickly re-explain the attributable to parent and the NCI portion of the profit. Okay, so on your profit, okay, so on this profit, remember there's a portion that we do not control. So we buy interest into a company for profit share, but there's a portion that we do not control, and that portion is 30%. But remember now, the profit that you see there is the profit for these two companies consolidated into one. So it's not 30% of that 2 million that we're going to get. That we don't control. It's 30% of the profit of Tribihani that we are not controlling. So then we have to calculate the profit of Tribihani. And to do that, I'm going to jump to the Excel. So there we calculated the profit. Okay, so it's Tribihani's revenue plus their other income minus their cost of sales minus their, I think that was operating expenses, minus their finance cost minus the income tax expense gives you Tribihani's profit. And then of their profit, there's a 30% that we do not control. And then we use this non-controlling portion. So of this profit, there's 188,106 that we do not control. And then the remaining portion belongs to the parent. Okay, I hope that helped a bit. Okay, then do you think the 2024 paper will be a similar format for this year? Probably. The biggest difference between the 2023 and 2024 were on 2024, they were focused on the profit and loss statement, where in 2023, they asked you to do all the journals. So it's more, I want to say it's almost a very similar format. If they focus more on statements, obviously they ask less journals, but you sort of still need the journal to actually do the statement. Okay. Then this isn't related to the paper, but rather the tests. How have past students found test 1? I must say for most students that actually attend class, semester 2 in general is easier for them. So then obviously their test 1 is better than what they did in semester 1. The only issue is if you are maybe a student that because of working or whatever, you can't really attend class, then we miss you somewhere along the line. Okay, because in semester 1, You could say, okay, I'm going to focus on, let's say, learning unit 2 because I understand that better. But in semester 2, you can't do that. We're building onto learning unit 1, then going into 2, going into 3. What they did prior to 2024, if you go and look at the exams, they ask one question. Okay, their exams were still 180 marks. Then they asked one question, which was 120 marks, which combined learning unit 1 to 5. So that's where the issue is coming in. If you miss some of the building blocks, then you're a bit lost. But otherwise, this might be the better semester for you. And then Keegan, you ask, isn't the disposing of assets learning unit 3? No, it is part of the learning unit 1 and 2. If there's control and they sell assets, there is a specific way that you do that. Okay, but we're going to look at that now. Okay, I think the questions are done for now. Okay. Okay, then I'm going to move to the 2023 paper. We might sort of run through this quickly, but I will share it with you as well when I share all the slides. So then you also have that. Okay, the 2.3 for, oopsie, sorry, there you go. Okay, so for 2.3, it's basically the NCI from all the journals. The elimination journal, the journal in the retained earnings movement, and then the non-controlling interest journal that we did for this year. Okay. Okay, what is the likelihood they will ask for percentage change in ownership from control to not having no control? That's a difficult question. Probably for this test, they might not let you lose control, or then also the other way around, gain control. Since learning unit 1 and 2, we are focusing on having control. Because if you lose control, you can't do the journals. Okay, so there might be a bit of a theory question if they really want to do that. But when it comes to calculations, that's not really going to work, because if they let you have no control, we can't do the journals. Your journals looks completely different. Okay, so I hope that helps a bit. You're selling a bit of their shares, still keeping control, that can happen. Or then also buying a bit more shares and still have control. That might happen. Okay, but not losing control or then gaining control as well. Okay. Then the 2023 paper. Okay, so just remember, same for last year in 2023, the paper was still out of 60 marks. For you, that changed. Okay, that's now only 50 marks. So you'll see they gave one question and it was 60 marks. Okay, so they tell us Metaverse is an investment holding company that sources assets in the tech industry across South Africa. Metaverse Limited's growth strategy is to acquire companies in the industry instead of organic growth. Below is an extract from the financial records of Metaverse and its related group investment companies for the year end 31 December 2021. Sorry, that was a mistake. It should be 2023. Okay, but in any case, so there you have Metaverse, you have NFT Limited, the debits, the credits. Then you'll see there's also additional information. So they tell us they acquired 80% of the ordinary shares. And then very importantly, they can appoint or remove 5 of the 7 directors. Okay, so that's also giving them control. The consideration paid was a cash amount of 1.5 million. And then they give you the equity basically at acquisition date. And now you'll see there's more equity. There's share capital, retained earnings, and a general reserve. And then they also tell you on acquisition, the fair value of the identifiable assets and liabilities were equal to the carrying amounts. And then at number 2, they purchased a machine with a carrying amount from Metaverse for 550,000. So you'll see there's a price difference. It's policy of the group to depreciate machinery using the straight line method. The remaining useful life of the machinery was 4 years. Okay, so just quickly on this machine. So remember, we're also going to eliminate the profit. And then when we eliminate the profit, the depreciation is also going to change. And the reason for that, for the one company, the carrying amount is 250,000. So they depreciate this machine at 250,000. But the other company now paid 550,000. So that 550 then becomes their cost. So they depreciate on the 550,000. Okay, so that's wrong. They need to depreciate this at the same amount. And if we eliminate the profit, the amount becomes the same. Okay, so we'll see how we're going to do that. Then there's also a loan with interest at number 3. At number 4, they sell 20% of their shares for a cash amount of 800,000. Then there's some general accounting information. I'm not going to really go through this. Important is number 6. There's a tax rate of 27%, capital gains tax of 80%. And then they ask you again to discuss whether there's control over NFT. I'm not going to let us go through that, just to save a bit of time. And then at 1.2, they ask you to do all the journals. Okay, so you can see there all the pro forma consolidation journals for the Metaverse Limited Group as at 31 December 2023. Narrations is not required. Show your calculations, round all amounts to the nearest rand. And then they ask you to prepare the consolidated statement of changes in equity. Okay, so let's quickly look at that. So first of all, the control. So as I said, I'm not really going to go through that, but you'll see again, we go to power, there's variable returns, and they have the ability to have an effect on these returns. Okay, and then you go to your question, you say they have 80% voting rights. They also have the majority voting rights with having 5 out of the 7 directors that they can appoint. Okay, so that's the theory. Okay, so now question 2 or 1.2 is then all the journals. Okay, so we said step 1. Okay, so you'll see I like the steps, so I always refer back to that. So please bear with me if this is not working for you. Just again, remember it's not compulsory. Okay, the steps is only there to try and help you remember all the journals. Okay, so if you don't like my steps, please, you're more than welcome to ignore that. Okay, so step 1 is at acquisition fair value. So we have to see if all the assets and liabilities are then equal to the fair values. And they tell us that at number 1, additional information, there at the bottom, they tell us on acquisition date, the fair value of identifiable assets and liabilities were equal to the carrying amounts. Okay, so on that, we're then not going to do step 1. But what did happen in this question is there was a fair value revaluation of the investment. And how you will know that is if you look there at number 1, they tell you the consideration paid was 1.5 million. Okay, remember in the previous question, I told you if they do not give you consideration paid, you have to go to your trial balance and check the value there. Now, if you go to your trial balance and you check the value there, you'll see the investment in NFT Limited fair value is 1,750,000. Okay, in the previous question, these two figures were exactly the same. No, now they're not. So there was a revaluation on the investment. Okay, so now we are going to credit investment with the difference between the amounts, which is 250,000. Just get there. 250,000. Then we debit mark-to-market reserve. This is the excluding the tax. And then on this 250,000, there's income tax, but there's also capital gains tax. Okay, and this is a reversal of the fair value adjustment. Okay, and then also very important, you will only reverse this if it's on the investment. Let's say they told you you have a building where there's a change, a revaluation. Then you will recognize that fair value adjustment. And in the next journal, you then also eliminate that revaluation. Where if it's on the investment, we don't do that. We just reverse the fair value. And then in journal 2, you'll see we just still eliminate at the consideration paid amount. Okay. Any questions up to this point? Yeah, you ask, do we always credit mark-to-market reserve or only if they tell us? Otherwise, we would fair value gain. Yeah, that's only if they tell you. But on the investment, it will probably always be mark-to-market reserve. Okay, then there's another question to just explain the buildings part again. Okay, let's see if they actually have buildings. Then we can somewhere. Okay, they don't have buildings, so they also have PPE. But what they will do is, so where in this question they tell you the fair values are equal, they will also tell you the fair value is equal, let's say, except for buildings, which is, let's say, 500,000. And then let's say on the trial balance, you actually had buildings and that buildings was, let's say, 400,000. Okay. So now you can see that the value for buildings is not the same. Okay. So what we do then is we debit buildings with 500,000 because sorry, not 500, the difference between the two. So it's 100,000. Because we have to increase the buildings. Then we will also have the tax. And then we will have revaluation surplus. Okay, or gain, whichever one. Okay, so then your tax is on the 100,000. We will have a 20% tax. And then that's the difference between the two. Okay, so if you had a change in buildings or inventory or anything like that, this is what it's going to look like. And then you say you recognize the revaluation to fair value of, let's say, buildings or whatever asset that was. But then if we then do journal 2, and I'm now just going to copy this one. Oh, no, I didn't do it there. Okay, so if you then do your elimination journal, then you will debit share capital. You'll debit retained earnings. Let's just do that. Debit retained earnings. And now you also debit revaluation surplus, which is the one that you just recognized. Okay, so then we debit that one. Then we credit the investment, we credit NCI, and then you will either have goodwill or gain on bargain purchase. Okay, so in the first journal, you'll then recognize the revaluation surplus, but then again, straight after that, you eliminate that revaluation surplus. Okay, whereas in this scenario, we credit the investment. You just get there again. Okay, so we credit the investment. And then you'll see in the second journal, we eliminate that full investment because basically now we've eliminated 250,000 of that. And then in the elimination journal, we eliminate the consideration paid, which then in the end is going to credit your investment with the full 1,750,000. Okay, do we have to do separate journals or can we just recognize it in the elimination journal if we do the analysis of equity? You're still going to have to do the separate journal, okay, because you're going to get marks for that. So you have to do that journal first. For the building revaluation scenario, you're not going to eliminate the tax. Okay, that will be fixed later on when we do the statements. Then the first journal be a separate statement and the second journal be in consolidated statements. Yes, yeah, basically. Yeah, so your first journal will be in the separate statements and then the second one in the consolidated statements. Okay. Any other questions before we take our break again? Okay, then you're asking, is the revaluation surplus amount going to be added to the statement of changes in equity? No, it's not, because in the next journal, we eliminate that revaluation surplus. Okay, so it's not going to be added to your statement of changes in equity. Okay, and then you ask just to show that surplus journal again. Okay, so there you have that. Okay. Any other questions? Okay, then you please show the full example you just did. You mean this one? Okay, so there we bring in the revaluation or we recognize the revaluation. And then when we do the elimination journal, we will then debit that surplus. In other words, eliminating that surplus.
So ma'am, isn't the 73K the goodwill or bargain purchase?
No. Okay. Any other questions? Okay, let's quickly see. Okay, I don't quite understand the tax effect of the elimination yet. Okay, I'll think about a proper way to explain that tax to you. Just give me a moment. And then Kaylin, you say yes, and the one above. There's not one above. So I'm not sure if you can just maybe explain a bit more, or do you just want to see this description? So maybe you can just please explain to me there what you're asking. Okay, so on the tax effect, I'll think about it a little in the break to properly explain that to you. And then I'll give you the proper solution or the answer there. I'll just want to think about maybe a nice way to explain that to you. And then I'll get back to you on that. Okay, so you can take your break. Let's now again go till 11:10. And then, yeah, we'll continue with this paper. Oh, sorry, Keegan, I say you ask what are the chances of a change in percentage question coming out? I would say it might be a good, since they are only testing you on Learning Unit 1 and 2. But yeah, it is difficult because as you can see in 2024, they didn't ask that, but in 2023, they did. So, yeah, it's a bit of a 50-50. Okay, so you can take your break and then at 10 past, we'll continue. Okay, let's continue. Yeah, see, there's a question. So they would never ask us to do the pro forma journals for when a subsidiary becomes IFRS 9 investment or the other way around. Not for this test. Okay, later on that can happen as we go through the other learning units, but for this test, no. Okay, so I'm just going to share my screen again. Okay, an in-class question we did, a subsidiary was valued at 50 more than its carrying value. The first journal debited the PPE with 50 and credited deferred tax with 14. The second and third journal accounted for the depreciation and tax. I'm not understanding how that scenario and the one we discussed differ. Okay, the difference is there you had PPE that was valued, whereas in the one we just did, it's your specific investment. So in other words, the money you paid to get your interest, where there was a fair value difference. Okay, but the PPE, okay, so in the one that I did now, just quickly the buildings one, where was that now? There. I didn't now do the depreciation and all of that. So you're also going to do that. Okay, this was just now focusing on your buildings for the revaluation, and that you then eliminate your revaluation again. The PPE, the thing is they have to specifically tell you what PPE it is. Is it land? Because then your tax is going to be different, because then there's capital gains tax in as well. Is it buildings? Is it whatever? And then that will definitely differ from your investment, because the investment, so the money you paid for that interest, we completely treat that differently. Okay, so let's continue. Okay, so we sort of just started the question. And then we had a look at step 1, where we said that all the fair values are fairly valued except for the investment amount. And that investment amount is then specifically the consideration that was paid. And then we said we have to credit that investment, because in the end, your total investment should be gone. Okay, we are eliminating that investment. So that investment shouldn't be there anymore. And then we debit mark-to-market reserve, and we debit deferred tax. Okay, then just on that deferred tax is not going to be eliminated. The reason for that is that SARS wants their portion. Okay, remember, this investment was actually, there was a fair value adjustment. And on that, we need to give a portion of that to SARS. When we eliminate journals, that's just because of consolidation. Okay, it doesn't mean this investment fair value didn't happen. It happened. It's just between the two companies, because we consolidate and we then sort of see it as one company, we don't want to show that fair value adjustment that we made. Okay, so I hope that's answering all the questions that we had on the tax. Okay. Then, oh, sorry, I just want to quickly show you the analysis is in this question. So if there are some of you that prefer to do the analysis, you can maybe do the analysis and then just check it with this one. So it is there. Okay. So I know a lot of students like to do the analysis and then the journals, because then you've basically got everything in there that you need. Okay, so then step 2 is the elimination journal. And remember, we are eliminating all equity at acquisition. And in this question, they actually gave that to you separately. They gave you the share capital, they gave you the retained earnings, they gave you the general reserve. So all of these will be debited. Your investment that you credit is the consideration paid, not the investment from the trial balance. It's the consideration paid. Then your non-controlling interest is on all this equity. There's 20% that we do not control because they tell us we acquired 80%. And then you can calculate whether you have goodwill or a gain on bargain purchase. Okay, so then that journal will look like this. So again, we have goodwill, 754,000. And you'll see narrations are not required. I just included it there so that you can just see what it will look like if it's maybe asked. Okay, then step 3 is that we now need to look at the movement for retained earnings or then any other equity from since acquisition to the beginning of the current year. And remember, we had retained earnings, but at acquisition, we also had the general reserve. Okay, so you have to do the movement for both of them. Okay, so your retained earnings was 492,000. The beginning of this year, it's 822,500. So it's the difference between the two. And remember, it's the non-controlling interest that we journalize. Same for general reserve. The beginning of this year, it's 440,500. At acquisition, it was 240,500. And again, we only do the non-controlling interest portion. Okay, so then that journal will look like this. You can also combine the journal. Okay, so you can say debit retained earnings, debit general reserve, and then we credit non-controlling interest only once. Okay. Then next is step 4. So step 4 is to eliminate all intercompany transactions. So all the sales of PPE, sale of inventory, management fees, loans, interest, rate. Okay, you have to go through your question and see what of these are applicable and then do elimination journals on all of them. Okay, so in the question, they tell us they at number 2 that they are selling a machine. And remember, we need to eliminate the unrealized profit. And that profit is the difference between the carrying amount and the selling price, or the amount that they purchased this machine for. So if you take the 550,000 minus the 250,000, we get a 300,000 profit that they made. And that 300,000 profit, we then need to eliminate. Okay, so we debit other income. That other income is basically the sale on this the profit on the sale of the machine, and then we credit property, plant, and equipment. And then again, remember, because we are affecting other income, we are affecting tax. So if you debit other income, your income is decreasing. So your profit will decrease. Therefore, your income tax expense is going to decrease. So that's why we then credit income tax expense. Okay, and then because we eliminate the profit that they make between one another, there's also an effect on depreciation. Because remember, we said the one company is depreciating at 250,000, the other one at 550,000. So there's also depreciation effect. And that depreciation is on the 300,000. So on the unrealized profit that we are eliminating, we then calculate depreciation. And it's divided by 4 because they tell you the remaining useful life is 4 years. And then again, if you affect depreciation, you are affecting your expense. But if we credit the expense is decreasing. If you decreases the expense, it's increasing your profit. If you increase the profit, you are increasing tax. And that's why we then debit income tax expense. Okay. Any questions on that sale of the PPE? Okay, Blessings, you ask, why do we journalize the full sales amount? So it's the profit that you are eliminating. Okay, I'm sure that's what you are referring to. So remember, we need to eliminate the profits between the two companies. Okay, so that's why it's the full amount. Okay, then we can continue. So now we have to see what other intergroup transactions are there. So remember, we're busy with my step 4. Okay, so we now did this purchase of the machine. Then there's an intercompany loan, and on that loan, there's 8% interest. Okay, so if you go to your trial balance, you'll see there's a loan receivable, NFT, 480. And then in the credits, you have loan payable to Metaverse, 480,000. Okay, so that's the loan amount. So then if you do your journal, you will then debit loan payable, loan receivable, and it's 480,000. And on that 480,000, we then calculate interest. Okay, remember in the previous question, the amount or the balances were different, and that's because they had a repayment. Okay, where in this question, they didn't tell us anything regarding repaying the loan. They just tell us they have a loan, and that's the interest percentage. Okay, so then we debit other income, we credit finance cost. Okay, then what else did they tell us? Okay, and then it's the part where they sell 20% of their non-controlling shareholders. Okay, we'll get back to that. Okay, so we did the elimination journal. We did the movement from retained earnings at acquisition to the beginning of the year. Same for general reserve. Then we did step 4. Okay, so all the intergroup transactions. we did the loan, we did the interest. Now we get to the non-controlling interest journal. Okay, if you go to your steps, that is then step 5, the non-controlling interest journal. So the easiest for that journal is if you did the analysis. Okay, then that non-controlling interest amount is on the analysis. Okay, but to get that, you take the profit for the year. And in this question, they were actually nice. They gave you that profit. So just after the trial balance, you'll see right there at the bottom, they gave you the net profit for the year. So if you take that profit amount and you times that with 20%, because that's the non-controlling interest percentage, then you get the non-controlling interest journal value. Okay, so that's the first one there. And then step 6, we said that's the dividends journal. So again, first you have to go to your trial balance and see if NFT paid any dividends. And there you'll see dividends paid on 30 June, 225,500. So remember we said that's the dividends paid amount, it's the amount from the trial balance. Then your dividends received will then be 80% of that amount, okay, or your other income. Okay, so then your dividends journal will look like this. So dividends paid, that's coming from the trial balance. Other income or dividends received is 80% of that amount. And then there's a portion that they do not control. Okay, and then lastly, we have the step 7, which is then the change in ownership. And you'll see they tell you there in the question that they sell, where is that now? Number 4, Metaverse sold 20% of NFT Limited to non-controlling shareholders for a cash amount of 800,000. So that 800,000 is going to the bank because we received the money. Okay, so that's bank 800,000. Then your non-controlling interest. Okay, so again, if you did the analysis, you'll easily find all these figures. It's on the analysis. I'll go back to that just now. And then we times that with 20 divided by 80. Okay, so they're selling 20%. They had 80% interest. And then the remaining will go to retained earnings. Okay, so on the analysis, I'll show you now where you get all those figures. Okay, let's quickly go to the analysis. So the first one is the 746,000. That's the value of the original interest that you purchased at 80%. Okay, so it's the 746,000. Then you plus the retained earnings. So basically the movement from at acquisition to the beginning of the year. You also add the general reserve movement. And then you add the profit for this year. Yeah, but just be careful, it's everything at the 80%. Okay, so we started off with the 746,000 plus the movement in retained earnings plus the movement in general reserve plus the profit for the year. Then times 20 divided by 80. Okay, so the 80 is what they had. The 20 is what they're selling. Okay, and that's then all the journals. Any questions on the journals? Okay, there's a question, why are the dividends paid not included in the calculation for the percentage change? The reason is they actually received the dividends. Okay, whereas the profit or the retained earnings, as their percentage change, that's going to change. Okay, but the dividends, that is what they should get at that stage when they decided to declare dividends. That's the percentage interest that they have, so they have to get that amount of dividends. That can't change as their percentages change. What happens if you're buying more shares? It's actually very similar when they buy more shares. Okay, I'll see if I can get an example of that maybe quickly for you. Could you go back to the slide regarding the analysis? Okay, I will do so. And then just repeat where the bank figure was from. Okay, let's quickly first do the bank one. That's a quicker one. The bank figure, so you'll see that at number 4, they tell you they sold 20% and it was a cash amount of 800,000. Okay, so they give you that 800,000. Okay, and then just the analysis of equity. So there you can see that as well. Okay, any other questions? Okay, so what happens if there's a fair value gain on land? It will be very similar to the example that I did for buildings. The only difference will be your tax, because then you also have to times the tax with 80% because there's capital gains also on land. Okay, so it's only the tax that's going to be different. Okay, then the retained earnings is the balancing figure. Yes, that's correct. Okay, so in that journal, you have your bank. You calculated that change in the percentage that they sell, and then retained earnings is your balancing figure. Okay, then also for this question, they ask you to do the statement of changes in equity. Sorry. Okay, that's then what that will look like. Okay, so the opening balance, your share capital will always be your parent company share capital. Okay, because remember, the other shares that we purchased, we've eliminated that shares. Okay, so you can't add that to the share capital because in your elimination journal, we eliminate share capital. Okay, so the opening balance is then only the share capital from the parent company. Then your general reserve, that 1.6 million is again the parent company, because remember, we also eliminated general reserve. Then the 200,000, that's the change in general reserve from the beginning of the current year and at acquisition amount. Okay, so it's the difference. But remember, we did a journal on the non-controlling interest part. So that 200,000, that's the full difference. But from that, we have to deduct 40,000 because this 40,000 will go to the non-controlling interest column. Okay, so the 40,000 we did the journal on. The 200,000 is the total, but of that, there's a portion that we do not control. Okay, same for retained earnings. The 2,535,500, that is Metaverse retained earnings on the trial balance. Then the movement in retained earnings from at acquisition to the beginning of the current year is 330,500. But of that, we did a non-controlling interest journal. So you have to deduct that 66,100 and it's added to the non-controlling interest part. And then your non-controlling interest, that's the journals we did at acquisition. Let me just quickly get there. There's your non-controlling interest at acquisition journal. And then we add the non-controlling interest for the retained earnings movement and also the general reserve movement. Okay, so then you have all your opening balances. Okay, then next, the profit for the year. So if they asked you to do the profit and loss statement, that profit for the year is going to come from that statement. But in this case, they didn't. So the first two figures you see there is the profit for the two companies. Okay, so on your trial balance there at the bottom, they gave you the profits, net profit for the year. So it's Metaverse plus NFT. And then we did a journal on the unrealized profit that we've eliminated. So we debited other income. So that's why it's a minus 300,000. Then the 81,000, I think that was the depreciation. Yeah. So your 81,000, oh, sorry, no, that was the tax on the 300,000. Okay, so it's an income tax expense. So it's 81,000. Then we have the depreciation and the tax on the depreciation. Okay, so you'll see there the 75 is the depreciation, 2250 is your income tax. Then we have then you have your dividends, that's the 180, 400. And then you minus the non-controlling interest part. Okay, so from your journal, you deduct that because this needs to be in the non-controlling interest column. Okay, then we get the change in ownership. And this change in ownership is again coming from your journal. So you'll see the 266 is your retained earnings and the 533 is the non-controlling interest. Okay, so that's coming from the journal. Then your dividends, and this dividends is also for the parent. So if you go to your trial balance, you'll see dividends paid, 255. Because again, remember the other dividends we've eliminated, so it's not there yet or anymore. So it's the 255,000 that will go to your statement. And then the non-controlling interest portion is your non-controlling interest from your dividends journal. And then we balance the statement. Okay. Any questions on the 2023 paper? Okay, that one I answered. If the parent buys from the sub, do we still debit bank? Yeah, you're still going to debit bank because they are the one receiving the money. Okay, wait. I understand your question now. If the parent buys from the sub, they're probably not going to do that for change in ownership, because for them to have an effect on the ownership, they're probably going to sell it to someone else. Okay, but if they buy from the sub, so if they buy more interest, then you're going to credit bank because then they're paying the money. Okay, I hope I'm understanding you correctly now. Okay, so if they buy more interest, then we're going to credit bank. But yeah, if they sell, then we'll debit bank. Okay, for the change in percentage journal, which debit credit had the calculation of the parent portion of the RE plus general reserve plus profit for the year?
Hi, you were
Yes.
doing a journal entry, and when you were doing it, you said that there was a calculation in it where we had to add in the parents' portion of their retained earnings, parents' portion of general reserve, and profit for the year. I just wanted to ask which entry in this journal would that be like pertaining to? Would it be the non-controlling interest
Yes.
or the investment?
Yeah, so it's the non-controlling interest portion.
Okay, perfect. Thank you so much.
Okay. Okay, any other questions? Okay, then this is it from my side. I will still be here for a couple of minutes, so if you have more questions, you're more than welcome to ask. I will then share the slides with your lecturers as well. But yeah, I know it might be a bit of a tight schedule. So yeah, if you want to send me an email, I've seen some of you already did. I didn't reply yet. I just quickly want to do for the 2024 paper, I just quickly want to add in all the journals that we did. And then I will reply and I will send the slides to you. So you're welcome to send me an email on that. But yeah, otherwise, good luck with your test. Good luck with the remaining of the prep for today. And yeah, I'm sure it will go well. And thanks for joining the session. We'll talk again for test 2. See, there's a question on my email. I'll quickly post that there. Rothman at varsitycollege.co.za. Okay, there you go. Okay, so now you also have my email address. Okay, then there's another question. If they ask us to calculate the final retained earnings balance, how would we do that? Is that now on the statement? You mean like this? So being that balance at year end? Just want to make sure I understand the question correctly. Okay, so this calculation then, because that's where we minus the unrealized profit, or is it not on the statement? Or are you referring to something completely different? Okay, the only thing that they can ask you is to calculate the profit for the year. That they can do. So if you then look at the consolidated profit for the year, it's the two profits for that company, for the two companies added together. And then you look at your journals and you see where did we affect income and where did we affect expenses. And the first one is we did it for the unrealized profit. Then there was tax on that profit. Then we had the depreciation. There was tax on the depreciation. And then we also had the dividends received portion. And then we just deduct the non-controlling interest part because that need to go to the non-controlling interest column. Okay, I hope that helps. Okay, I hear the emails popping in. Okay, so I will reply just after the session. Okay, so you must have a lovely day tomorrow and a lovely taste. I really hope it's not too bad. And yeah, like I said, I will still be here for a while. So if you have questions, you're welcome to ask. But otherwise, we'll speak again for test 2. Kaylin, you're asking if they ask you to do the journals, do you need to do both the analysis and the journal entries? It's not necessary to do the analysis. Okay, that will never be compulsory. It's just something nice to help you with calculations. And then if you do the analysis, you don't have to show your calculations in the journals, because then we use the analysis to give you the marks for the calculations. But you have to do the journal entries. Okay, so the analysis, that's optional. Whether you like, some students don't like to do the analysis, so then it's fine. They don't have to, but then just show your calculations in the journals. So if you prefer the analysis, you do the analysis, and then that's your calculations. So then it's fine. Okay, you ask, can we do the workings first in a table form with combined consolidation adjustments and consolidated, then do the consolidated SFF or SPL and OCI? Because of the examples that we were given, has it done like that? Yes, I'm sure that can work. Especially if your lecturer did it with you like that, then they will definitely take that into consideration when marking. Okay, so yes, then you can do it like that.